Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Investing in Secondary Offerings, what you need to know. Understanding the offering terms. The terms of a secondary offering can significantly impact its attractiveness. Here are some critical points to focus on. Offering price. This is the price at which new shares are being sold. Compare it to the current market price. If the offering price is much lower, it might be a red flag. Number of shares. This tells you how much dilution will occur. More shares mean existing shareholders' stakes will be diluted. Lockup periods. These periods prevent insiders from selling their shares for a certain time. A longer lockup period can indicate confidence in the future performance of the stock. Understanding these terms helps you gauge whether the secondary offering aligns with your investment strategy. Remember, every detail counts, and sometimes a small term can make a big difference. Evaluating secondary offerings requires a careful look at both the company's fundamentals and the specific terms of the offering. By following these guidelines, you can make more informed and confident investment decisions. Risks associated with secondary offerings. When investing in secondary offerings, it's crucial to know the potential risks involved. Secondary offerings can impact the stock's price and influence your investment strategy. Let's break down some of the key risks. Market timing and price fluctuations. Market conditions can play a huge role in the success of a secondary offering. If the market is doing well, a secondary offering might be priced higher, making it less attractive for new investors. On the flip side, if the market is struggling, the offering might be priced lower, but the stock could still face significant price drops. Consider this scenario. A company decides to issue more shares, and just days later, the market takes a downturn. This can lead to the stock price falling below the offering price, resulting in immediate losses for investors. Market timing can be as unpredictable as the weather, making it a critical factor to watch. Volatility. Stocks can become more volatile during a secondary offering. Demand and supply. More shares on the market can dilute the stock value. Timing is everything. Market conditions at the time of the secondary offering can either amplify or diminish the investment's potential. Long-term versus short-term investment strategy. Your investment strategy also determines how a secondary offering impacts you. If you're a long-term investor, you might be more willing to ride out any initial turbulence caused by the offering. However, if your strategy is short-term, you could be looking at quick losses or gains, depending on the market's reaction. For long-term investors. Potential for growth. You might view the secondary offering as a chance for the company to raise funds and grow, leading to higher future returns. Dilution. More shares mean your ownership percentage decreases, which can dilute earnings per share, EPS. For short-term investors. Price swings. Secondary offerings can cause temporary price swings, which can either be a boon or bane. Quick gains or losses. Timing your entry and exit points becomes even more crucial. In essence, how you view secondary offerings depends on your investment horizon. It's like deciding whether to go on a short sprint or a marathon. Each has its own set of challenges and rewards. By understanding these risks, you'll be better prepared to navigate the complexities of secondary offerings and make informed investment decisions. Case studies of notable secondary offerings. Secondary offerings can either boost a company's growth or sometimes hurt it. Let's look at some notable examples of both successful and challenging secondary offerings. Successful secondary offerings. Amazon, 1998. Amazon's secondary offering in 1998 was a smart move. The company raised $326 million to fuel its rapid growth. This extra capital helped Amazon expand its operations, acquire new businesses, and innovate. Investors who believed in Amazon at this stage saw their shares grow significantly over the years. Tesla, 2020. Tesla conducted a secondary offering in February 2020, raising $2 billion. This helped the company strengthen its balance sheet and fund future projects. The stock price increased substantially after the offering, rewarding investors who stayed on board. Facebook, 2013. In 2013, Facebook announced a secondary offering to raise $3.85 billion. This was used to cover taxes on stock options and to buy back shares. The move eased investors' concerns about the company's financial health, leading to a rise in stock price. Challenging secondary offerings. Groupon, 2011. Groupon's secondary offering in 2011 wasn't well received. Initially, the company raised $700 million, but its stock plummeted soon after. Investors were skeptical about Groupon's business model and future profitability. The stock price continued to fall, hurting those who invested during the offering. Blue Apron, 2017. In 2017, meal kit company Blue Apron completed a secondary offering that did not go as planned. The funds raised did not lead to the expected growth. Competition was fierce, and the company's stock price fell dramatically. Many investors saw their investments lose value. Zynga, 2012. When Zynga conducted a secondary offering in 2012, raising $515 million, the outcome wasn't positive. The company's shares dropped 10% the day after the offering. Concerns over Zynga's reliance on Facebook and doubts about its future earnings led to a decline in stock price. Understanding the outcomes of these secondary offerings provides valuable lessons for investors. While some companies thrive and grow, others fail to meet expectations, impacting their stock prices and investor returns. Conclusion: investing in secondary offerings can be a savvy move for those who know what to look for. Understanding the reasons behind the offering, the company's financial health, and market conditions are key factors to consider. Secondary offerings can dilute share value but also provide opportunities to invest in growing companies. They offer a chance to buy stocks at a set price and can be a part of a balanced investment strategy. Approach secondary offerings with a well-informed perspective. Do your research, weigh the pros and cons, and make educated decisions. This can lead to smart investments and a stronger portfolio. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.